Thank you very much. Well, the subprime problem Lindsay talked about is certainly a big one for many homeowners, but it's also a growing problem for investors who own any subprime-linked debt. One of the biggest problems is lack of transparency. People just don't know how much or what this debt may be worth. Joe Fichera thinks that he may have the answer to this growing problem. He is CEO of Saber Partners in New York, and he joins us now. And you know, former SEC Chairman Richard Breeden, investigating junk bonds, came up with the fixed income pricing service, basically trying to add some transparency and visibility to junk bonds years ago. You'd like to do the same thing with some of this type of debt.
Well, I think we have to make sure that we understand there are two distinct problems here. One is the transparency of the underlying collateral and the securities that are making up the security. And then there is market price transparency. With Breeden and with trace eligibility in the corporate bond, we're talking about market price. We're not talking about the transparency and the opacity of the underlying collateral. That's where you got a big problem now in market price transparency.
And people are relying on Moody's and S&P to try to give them a little transparency vis-a-vis the credit ratings.
That is correct, and also dealers and other things, models that will evaluate this collateral and in a very sophisticated way put a value on it. But we have now the dispersions in terms of models and pricing by different models. But you want to go from models to markets, to where the security actual trades. As I said, market transparency, price transparency doesn't solve the subprime problem. That's a bigger problem of even potential fraud at the very lowest levels in terms of originators and such and on the collateral. But what you want to do once you own securities, you want to know what they're worth. You want to know what other people will be able to pay for them.
Do you really want to know what they're worth? Because I've heard some hedge fund managers say it may be a very scary day when some of this stuff is finally marked to market and we know exactly what people are bidding at.
I think that is as a result of what the problem has been built up since we did not use the trace system that went for the corporate bond market in the ABS market as it came through from 2001 and finishing up in 2006 with real-time pricing. ABS was exempted. I'm never quite clear why ABS was totally exempted from it, but it was. And as a result, we have transparency that it is pretty more spotty in terms of how brokers will post what they will be willing to make market widths and trades, major investors who do put things on bid lists, and they'll know where things actually have trade. But then that information is not disseminated widely. It is within smaller groups of information, and it's not enforced by a central authority like the NASD.
Do you think do you have any support for your idea? I mean, do you think there's any support for this type of an idea? Or maybe when this is all said and done, and Congress has already said that they'd like to do something, I'm not sure they know what. Do you think there'll be support for this type of an idea?
I think everyone generally believes that transparency is good in all markets, where you have, and that the greater sunshine is the best disinfection for any type of problem. There was a great deal of concern about whether you could bring transparency to the municipal market, and that it was too fragmented or too small, too complicated. But that happened, things went well, and it brought more investors confidence because you had pricing histories to see. You also could bring other broker-dealers, other market makers in. It wouldn't be concentrated to just the people who originated the transaction or who were in the selling groups and such. And this can help everyone. The problem is always when you're trying to make a change is the transition costs associated with that. Going from
and people who have bought these instruments or sold them or brokered them because they can take price manipulation or not manipulation. You know, they can make their money from that lack of transparency. There's a spread there. And if there's no spread, then it pushes people out of the market.
Tighten because of more information.
That's right.
It makes less money. But what you can do is always make that up in volume by greater trading, by bringing in more investors, by providing greater liquidity. Transparency, market price transparency has been effective in the corporate bond market. It has been effective in the high yield market, and probably one of the reasons why high yield bonds got tighter because people got more confident. They bid them tighter in terms of what they've actually saw where individual trades happen. What you're going to have now probably are what we call dislocations of capital and reallocations of capital amongst investors and such. Okay. And there is that great fear about once we do this, what will it be?
All right.
We're going to have some changes.
Got to leave it there. Joe Fichera of Saber Partners. Joe, pleasure. Thank you very much. Trying to bring some transparency to that market. All right, coming up after the break. Hang out just for 1 second, Joe. After the break, we're going to go live to Sun Valley, Idaho, and get you an update from the Allen & Company Conference. Stick around.